In March of 2009, a retired schoolteacher named Barbara sat at her kitchen table and made a decision her financial advisor told her was a mistake. She was 61 years old. Her retirement account, which had been worth $340,000 18 months earlier, had fallen to $189,000. She had watched it decline for a year and a half through what the news was describing as the worst financial crisis since the Great Depression. Her advisor had called twice in the previous month suggesting she move what remained into bonds and money market funds before the losses got worse. Barbara had no financial training. She had no Bloomberg terminal, no institutional research, no sophisticated understanding of market cycles. What she had was a memory. She remembered her parents talking about the 1970s. She remembered watching her father not sell his modest stock holdings during the 1987 crash and come out the other side without having locked in the losses. She remembered something simple that she had read once and never forgotten: the time to be afraid of the market is when everyone else is comfortable, and the time to be brave is when everyone else is afraid. Everyone she knew was afraid. She did not move to bonds. She kept everything she had in the market. And then she did something her advisor specifically told her not to do. She increased her monthly contribution. By 2019, 10 years later, Barbara's account was worth $1,140,000. Now I want to tell you about her neighbor, Philip. Philip was 58 in March of 2009. Similar retirement account. Similar career. Similar financial starting point. He had also watched his account decline. He moved to bonds in February of 2009, approximately 3 weeks before the market hit its absolute bottom. He waited for clarity, for the headlines to improve, for the fear to subside, for things to feel safe again. He re-entered the market in late 2010, after the recovery had already produced its most significant gains. By 2019, Philip's account was worth $410,000. Same year. Same starting point. Same amount of time. A difference of $730,000 between two neighbors who made different decisions during the same period of maximum fear. Barbara didn't get lucky. She didn't have information Philip didn't have. She had a framework, a simple, historically grounded understanding of what moments of extreme market fear have consistently represented throughout investment history. And that framework, applied at the exact moment when almost everyone around her was doing the opposite, produced an outcome that changed the shape of her retirement entirely. We are living through a moment that rhymes with March 2009 in specific and measurable ways. Pause. Music fades in softly. This isn't about predicting the market. It's about understanding that specific economic conditions, the kind that produce fear, uncertainty, and the overwhelming social consensus that now is the worst possible time to invest, have historically been the exact conditions under which ordinary people who stay invested, and invest more, build the kind of wealth that transforms their financial lives. I'm going to show you the real rules of what happens when fear peaks in financial markets, the historical patterns, the specific conditions that have repeatedly preceded periods of extraordinary wealth creation for ordinary investors, the psychological traps that cause most people to do the opposite of what the math recommends during these windows, and the exact framework that separated Barbara from Philip and will separate the investors who look back at this period with satisfaction from those who look back with regret. These are the rules that every wealthy long-term investor has internalized and that most people only understand in retrospect, when the window has already closed. Transition to core content. Rule 1. The moments that produce the most long-term wealth for ordinary investors are always the moments that feel most dangerous, and this is not a coincidence. It is the mechanism. This is the foundational rule that explains Barbara's outcome and Philip's outcome simultaneously. The stock market is a pricing mechanism. It prices expectations about future earnings across thousands of companies. When fear is high, when the news is bad, when recession is present or expected, when unemployment is rising, those expectations deteriorate. Prices fall to reflect the pessimistic consensus about the future. And when prices fall, the forward return on every dollar invested increases, because you are buying a claim on future earnings at a lower price. The mathematical relationship is direct and consistent. The lower the price you pay for a dollar of earnings, the higher your return when those earnings materialize or exceed expectations. This means that buying during periods of peak fear, when prices are lowest relative to the underlying value of the businesses, has historically produced the highest subsequent returns. This is not a theory. It is the historical record. The 10 best single-day gains in S&P 500 history have occurred during bear markets and periods of economic crisis, not during calm and optimistic conditions. The best 10-year periods of wealth accumulation have consistently begun during recessions, financial crises, or periods of broad economic fear. The investors who built the most wealth did not do so by identifying the right companies or predicting the future with accuracy. They did it by buying during the periods when everyone else was selling, and holding while everyone else was waiting for safety. Barbara's advisor told her the market might fall further. It might have. He was right to note the risk. But he was applying short-term risk analysis to a long-term investment decision, and those two frameworks produce opposite answers to the same question. Rule 2. Every major period of ordinary investor wealth creation in modern history followed a period of maximum fear, and the pattern is consistent enough across a century of market history to constitute a rule rather than a coincidence. The evidence for this rule spans more than a century of market data, and the pattern repeats with enough consistency that dismissing it requires actively ignoring the historical record. Following the crash of 1929 and the Depression years of the early 1930s, the investors who held or added to their equity positions were rewarded with the extraordinary post-war economic expansion that produced some of the most durable wealth creation in American history. The fear during those years was existential, genuine uncertainty about whether capitalism and democratic institutions would survive in their current form. The investors who stayed were generationally rewarded. Following the stagflation and market malaise of the 1970s, a period characterized by double-digit inflation, oil shocks, political crisis, and what Business Week famously called the death of equities, in 1979, the subsequent decade produced some of the strongest equity returns in market history. The people who bought in 1979 when Business Week declared equities dead captured returns that defined their retirements. Following the dot-com crash of 2000 to 2002, investors who continued contributing to index funds through the decline and the early 2000s emerged from the decade positioned for significant wealth building. Following the financial crisis of 2008 and 2009, investors like Barbara who held and added during maximum fear captured the 11-year bull market that followed, one of the longest and most powerful in recorded history. The pattern is not that crisis predicts recovery with certainty. The pattern is that crisis produces the low prices that make high subsequent returns mathematically probable, and that most ordinary investors miss this window by doing the rational feeling thing, which is to wait for safety. Rule 3. The wealth gap created during periods of market fear is not primarily about who invests and who doesn't. It is about who continues investing and who temporarily stops. This rule addresses a specific misconception about how the wealth divergence between Barbara and Philip actually happened. Philip did not lose all of his money. He made a reasonable, defensible decision to reduce equity exposure during a period of genuine crisis. He re-entered the market in 2010. By most measures, he made a sensible, cautious choice that preserved his capital during the worst of the decline. What he missed was not the full bull market. He participated in most of it after re-entering in 2010. What he missed was the initial recovery, the period from March 2009 to approximately December 2010, during which the S&P 500 returned approximately 67%. The investor who moved to bonds in February 2009 missed the bottom by 3 weeks and then missed the initial 67% recovery by waiting for clarity. 67% on a $189,000 account is approximately $127,000 in gains in 21 months, gains that compound forward across every subsequent year. The wealth gap between Barbara and Philip was not produced by a decade of different behavior. It was produced largely by 3 weeks of different behavior at the exact bottom of the market, compounded forward for 10 years. But here's what most people miss. The investors who capture crisis bottom gains are not the people who predicted the bottom. They are the people who never left. They didn't time the market. They were already there when the recovery began because they had never moved to safety in the first place. Rule 4. The specific conditions that have historically preceded major wealth creation windows are identifiable, and several of them are present right now in ways that have direct implications for investors who understand the pattern. This rule requires careful framing because it is not a prediction. It is pattern recognition applied to current conditions, the same exercise Barbara was doing in 2009 when she remembered her father's experience in 1987. The conditions that have historically characterized the beginning of major wealth creation windows include several identifiable features. Elevated market volatility, measured by the VIX Fear Index, above historical averages. Widespread consensus in financial media that the economic environment is uniquely dangerous and that traditional investment approaches may not apply. Significant outflows from equity funds as retail investors move to perceived safety in cash and short-term bonds. Recession fears that are either present or actively discussed by mainstream economists. Consumer sentiment readings at historically low levels. And valuations that have declined meaningfully from recent peaks, improving the forward return mathematics. The current environment contains several of these features in measurable ways. Consumer sentiment surveys have been running below historical averages. Financial media coverage has been dominated by uncertainty narratives, trade disruptions, geopolitical instability, inflation concerns, recession probability estimates from major institutions. Retail investor sentiment surveys have reflected elevated bearishness. Volatility has been elevated relative to the post-pandemic calm. None of this confirms that a major market advance is imminent. The pattern recognition is probabilistic, not predictive. What it does confirm is that the current environment rhymes with conditions that have historically preceded significant wealth creation for investors who remained invested, and that the feeling of danger, which is real and understandable, is not the same as the mathematical reality of forward return probability. Rule 5. The investors who become millionaires during periods of economic fear are not the ones who predict what happens next, they are the ones who understand what has already happened. This is perhaps the most important distinction in this entire video, because it separates actionable wisdom from speculation. Barbara did not predict that the market would bottom in March 2009. She could not have known that. Nobody knew that in real time, the March 2009 bottom was only identifiable as the bottom in retrospect. What she knew was historical, that previous periods of maximum financial fear had been followed by significant recoveries, that the investors who captured those recoveries were the ones who remained invested during the fear, and that the evidence she had available suggested the market was pricing in an extremely pessimistic scenario that had historically been followed by improvement. This distinction, between predicting the future and responding to the present, is the difference between trying to be smart and trying to be right. Trying to be smart means waiting for clarity, which means waiting for prices to recover, which means missing the best entry points. Trying to be right means acknowledging that the historical record strongly suggests remaining invested during fear produces better outcomes than waiting for safety, and behaving accordingly regardless of how uncomfortable it feels in the moment. The ordinary people who became millionaires during the post-2009 recovery were not financial experts who predicted the recovery. They were ordinary investors who had internalized one lesson from history well enough to apply it when applying it felt genuinely frightening. Most of them, if asked in March 2009, would have said they weren't sure what would happen. They just knew that selling into maximum fear had historically been the wrong answer, and they declined to make the historically wrong decision even when the social environment around them was making it feel like the rational one. Rule 6, dollar cost averaging during periods of market decline is the specific mechanism by which ordinary investors capture the returns that crisis conditions make available, and most people stop doing it at exactly the wrong time. Dollar cost averaging, contributing a fixed dollar amount to investments at regular intervals regardless of market conditions, is not a sophisticated strategy. It is a simple, systematic approach that produces a counterintuitive result during market declines. The more the market falls, the more shares your fixed contribution purchases. Here is the arithmetic that most people have internalized intellectually but abandon emotionally during actual declines. If you contribute $500 per month to an index fund and the fund's share price falls from $100 to $60, your $500 contribution buys 8.3 shares at $60 rather than 5 shares at $100. When the price recovers to $100, your 8.3 shares are worth $830 rather than the $500 you contributed. The decline produced a better entry point. The systematic contribution captured it automatically. This mechanism requires only one thing to work, continuing the contributions during the decline. And this is precisely what most investors stop doing. The combination of portfolio losses already sustained and media coverage emphasizing further potential losses creates a psychological environment where the systematic contribution, which is the source of the long-term wealth building, feels like adding money to a losing situation. Barbara increased her monthly contribution during the 2009 decline. Philip stopped his. The investors who increased contributions during the 2020 COVID decline captured one of the fastest market recoveries in history. The investors who stopped contributing locked in losses and missed the accumulation opportunity that the decline presented. Rule 7, the financial media environment during periods of market fear is specifically structured to produce the most wealth-destroying investor behavior, and understanding this is not cynicism. It is self-protection. Financial media exists in an attention economy. Attention is captured by fear more reliably than by calm. A headline reading, "Market uncertainty creates significant long-term buying opportunity for patient investors," does not drive clicks. A headline reading, "Recession fear deepens as market decline accelerates," drives clicks. The incentive structure of financial media systematically produces content that amplifies fear during declines and amplifies complacency during peaks, the opposite of what is financially useful for individual investors. The correlation between financial media negativity and market bottom proximity has been noted by researchers. Some of the most aggressively negative financial media coverage in modern history, the Business Week, Death of Equities, cover in 1979, the Time magazine, Home Sweet Home, cover at the bottom of the housing market in 2011, widespread financial media crisis framing in March 2009, has coincided with or preceded major market bottoms and subsequent wealth creation periods. This is not because financial journalists are deliberately misleading their audiences. It is because financial media reflects the sentiment of the moment accurately, and the sentiment of the moment at market bottoms is genuinely and reasonably fearful. The problem is that sentiment-based decision-making, applied to long-term investment choices, produces systematically poor outcomes. The media accurately represents how people feel. How people feel at market bottoms is the opposite of how they should act. Phillips' decision to move to bonds in February 2009 was informed by media coverage that was, in its description of economic conditions, accurate. The financial crisis was real and severe. The coverage was not wrong. It was simply not the right information for making a long-term investment decision. Rule 8. Wealth creation during crisis periods is not distributed equally, and the specific investor behaviors that capture the most wealth are different from what most people assume. The investors who built the most wealth during previous crisis periods were not primarily the ones who made the most concentrated bets on recovery. They were not the people who correctly predicted specific companies that would benefit most from the subsequent recovery. They were the people who maintained or increased broad market exposure during the fear period and held it through the recovery. The mathematics of this are straightforward. The S&P 500 from March 2009 to February 2020, before the COVID decline, returned approximately 400%. An investor with $100,000 at the March 2009 bottom, holding a simple S&P 500 index fund, had approximately $500,000 11 years later without making any additional contributions. An investor who added $500 per month during that same period had significantly more. Neither of these investors required any specific stock-picking skill. They required two behaviors: remaining in broad market exposure during the fear period and continuing to add to their positions rather than reducing them. The wealth creation was available to any ordinary investor with an index fund account and the behavioral discipline to not respond to fear with selling. But here's what most people miss. The investors who attempted to optimize their crisis positioning, trying to identify the specific sectors or companies that would lead the recovery, moving to cash to time the exact bottom, or waiting for economic clarity before reinvesting, generally underperformed the investors who simply held the index. Complexity and sophistication were not rewarded. Patience and continuity were. Rule 9. The specific tax-advantaged actions available during market downturns are among the highest return financial decisions available, and almost no one takes advantage of them. Market downturns create specific tax planning opportunities that are available only when prices are depressed, and the financial return on these opportunities is immediate and guaranteed, unlike the market return, which is probable but uncertain. Roth IRA conversions during market downturns allow investors to convert traditional IRA balances to Roth IRA status at a lower tax cost. When your portfolio has declined 25%, converting $50,000 of traditional IRA assets to Roth costs you taxes on $50,000, but those $50,000 of assets represent more shares of your underlying investments than they would have before the decline. When the recovery occurs, those shares recover in value inside your Roth account, where all future growth is permanently tax-free. The decline created an opportunity to move more future wealth into a tax-free structure at a lower present tax cost. Tax loss harvesting, selling securities that have declined to capture the tax loss, then immediately reinvesting in similar but not identical securities to maintain market exposure, allows investors to generate tax losses that offset current or future capital gains. The result is a tax benefit without meaningfully changing your investment position. You remain invested. You capture the deduction. The after-tax return improves. Both of these actions are available during every market decline and captured by a small minority of investors. Most people are focused on the decline itself, on the pain of watching balances fall, and never examine the tax planning opportunities that the decline simultaneously creates. The financial advisor who calls during a decline to suggest tax loss harvesting or Roth conversion opportunities is doing more practical good than the one calling to suggest moving to safety. Most advisors, unfortunately, make the latter call. Rule 10, the size of the subsequent wealth creation period is roughly proportional to the size of the preceding fear, and the investors who understand this relationship approach volatility differently than those who don't. This rule requires nuance because it is not a precise mathematical formula. But the directional relationship is well documented. The 2009 recovery following the deepest fear of the financial crisis produced one of the longest bull markets in history. The 2020 recovery following COVID panic produced one of the fastest recoveries in history. The 1982 recovery following the depths of 1970s stagflation and recession produced one of the strongest 20-year runs in market history. The magnitude of the subsequent advance is correlated, roughly, with the magnitude of the decline and the fear that preceded it, because larger declines create larger valuation improvements, which create larger forward return potential. This relationship changes how a historically informed investor interprets bad news. When the fear headlines are most aggressive, they are simultaneously describing an economic environment and creating the valuation conditions that make future returns most attractive. The bad news is real. And the bad news is also doing the work of establishing the low prices that make subsequent wealth creation possible. I'm not done yet. This framework does not require predicting when the fear will end or the recovery will begin. It requires only recognizing that fear-driven price declines have historically resolved in favor of patient investors over investment horizons of 5 years or more, and acting accordingly by maintaining or adding to equity exposure during the fearful periods, not despite the fear but specifically because of what the fear has done to prices. Rule 11, the ordinary people who became millionaires during previous crisis periods share one characteristic that was not wealth, not intelligence, and not sophisticated financial knowledge. They had a specific belief about what downturns represent. Barbara's belief, formed by watching her father through the 1987 crash, was simple enough to state in one sentence: market downturns are temporary mispricings of permanent businesses, and the investors who hold permanent businesses through temporary mispricings are rewarded for their patience. This belief did not require a finance degree. It did not require reading annual reports or understanding monetary policy. It required only a mental model of what the stock market represents, ownership stakes in real businesses with real earnings, and a historical understanding that temporary declines in the price of those stakes have consistently resolved upward over meaningful time horizons. Philip's implicit belief was different. He experienced the market as a price-based reality. The price was falling, the trend was bad, prices reflect reality, therefore reality was getting worse and would get worse still. His selling decision was rational given this belief. If prices reflect reality and reality is deteriorating, reducing exposure is correct. The difference between the two beliefs produces opposite decisions in identical circumstances. And the historical record strongly supports Barbara's belief over Philip's, not because prices are always rational in the short term, but because the businesses underlying those prices continue to generate earnings, adapt to difficult conditions, and recover over time in ways that eventually reassert themselves in prices. This belief is learnable. It is transmissible. It is the foundational mental model that every long-term wealth builder has arrived at through some combination of reading, experience, and mentorship. And it is completely absent from the financial education most people receive. Transition to closing. Barbara and Philip are both in their late 70s now. They are still neighbors. They have maintained the cordial relationship of people who have lived near each other for decades and share the ordinary rhythms of neighborhood life. They don't discuss money directly, but their retirements look different in ways that are visible without discussion. Barbara travels. She has helped her grandchildren. She replaced her car when she wanted to rather than when she had to. She has, in the way that genuine financial security expresses itself, stopped thinking about money as a source of daily concern. Philip's retirement is comfortable in the modest sense. He is fine. He is not suffering. But the retirement he had imagined, the one he had been building toward when his account was at $340,000, is not quite the retirement he is living. The gap between them was not produced by a decade of different financial behavior. It was produced by 3 weeks of different behavior during the most fearful period either of them had ever experienced, compounded forward for 15 years. Philip made the rational decision. The one that felt right. The one his advisor recommended. The one that was consistent with how everyone around him was feeling and behaving. He was not foolish. He was human. He responded to an environment of maximum fear the way humans consistently respond to environments of maximum fear, which is to seek safety. Barbara made the historically informed decision. The one that felt frightening. The one her advisor advised against. The one that required ignoring the overwhelming social consensus about what prudent behavior looked like and acting on a simple, historical understanding of what market fear has consistently represented. We are living through a period that rhymes with the moments that preceded previous wealth creation windows. Not identically. Not with certainty. But with enough of the same structural features, fear, uncertainty, declining valuations, the social consensus that caution is the only rational response, that the historical pattern deserves serious attention from every investor deciding what to do right now. The question is not whether the market will recover. Over every meaningful investment horizon in the past century, it has. The question is whether you will be invested when it does. Barbara was. Philip wasn't. One of them became a millionaire. The other retired with $410,000 and the quiet awareness of a different outcome that was available and missed. The window that creates Barbara's outcome is not open forever. It rarely is. OUTRO, measured, deliberate, unhurried. End card. If this video changed how you're thinking about the current market environment, share it with one person who is sitting in cash right now waiting for things to feel safe. The next video in this series walks through the exact framework for how to position your portfolio during periods of elevated market fear, not predictions, just the historically informed structure that has produced the best outcomes for ordinary investors in every previous version of this moment.